Okie dokie. Okie dokie, everyone. First of all, can I wish every single one of you, depending where you are around the world, a very good morning, or a very good evening, or a very good afternoon. Like I say, depending where you are around the world. First of all, thank you so much for joining me tonight on tonight's webinar, which I hope you'll find insightful. This one's, of course, is about how I got started to understand gold trading. Obviously written by myself, this is James Truskothic, and I'm the chief trading educator here at Stratton Markets. Now, before we get on to tonight's agenda, well, we'll go over obviously what topics we're covering in relation to gold. Obviously, we're talking about online trading and CFD trading, which, like every sort of investment, does carry a great deal of risk. So I do suggest, though I will be obviously talking and occasionally maybe expressing occasional opinion, at the end of the day it's just an opinion, and this webinar is purely for informative purposes only. I do suggest you do your own due diligence and your own research and know the risks involved before entering any trade. Now, with that out of the way, like I say, let me first of all introduce yours truly. Like I said, my name is James Truskothic. I'm the chief trading educator here at Stratton Markets, and that's me there, the hairy, wrinkly picture there, and you see on your right. I have over 20 years experience in the financial service industry. I actually started off at the age of 18. Where I actually started off with mortgages. Obviously, back in the UK, as you can tell, I'm a Brit, so don't hold that against me. Yeah, so I started off in mortgages at the age of 18. And I sort of worked my way up as a qualified mortgage broker, where I specialized in commercial mortgages, buy-to-let mortgages, and unfortunately, I also dealt with the subprime market. I then moved into pensions, became a qualified IFA, where I did pensions and alternative investments before entering this arena around about 12 years ago. In this arena, I have actually traded myself, obviously. I traded gold options through the Dubai's Gold and Commodities Exchange. I also ran a floor at the Philippines Stock Exchange. And there's a question, hang on. Bear with me, I will ask questions in a little while, don't worry. At the end, I will answer any questions. Like I say, so yeah, over 25 years experience in the financial markets, and I would say 12 years on the online trading arena. Like I said, I traded through Dubai. I also ran a floor in the Philippine Stock Exchange before I moved into portfolio management, where I obviously looked after very high-profile clients before getting to grips with education and sort of sharing my experience and my knowledge. I am indeed a published writer, and I have been published in several leading industry publications, including the Financial Times Advisor, Market Watch, FX Traders Magazine, and several newspapers, etc., which is not bad considering I'm a terrible writer. I'm also an avid market commentator. I'm very passionate indeed about the markets, and I'm also a well-known public speaker, and I've spoken through several industry events all around the world. And though I do have some knowledge, I do have some experience in this industry, I never call myself an expert because I don't believe there is such a thing as an expert in this field. However, I will show you my experiences, my opinions, and hopefully you'll find it some educational, and hopefully will help you build on your studies in this industry. Now, tonight's agenda, as we really know from the title, is basically about gold. Okay, and how I got to understand gold trading. So I'll be doing like an introduction to the oldest currency in the world, a bit of history lesson there because I find it fascinating. Then I'll be talking about the ultimate love-hate relationship, which is gold versus the US dollar. This is a relationship you need to have understanding of if you want to understand gold trading. Then, of course, we'll talk about the yellow metal. That's another name for gold. Why is protection from global concern and inflation? We'll talk a little bit about the fundamentals of gold as well. Then we'll talk a little bit about the commitment of traders report, which I find very useful to sort of understand, maybe to sort of gather what sort of market sentiment it is. Later webinars I'll do a bigger webinar on commitments of traders report. But we're going to have a brief introduction to that. Then we'll talk about supply and demand. And of course, we'll do the question and answer session. And like I say, at that point, I'll answer all your questions for you then. So, one of the oldest currencies in the world. Okay, now gold has always played a key role in the monetary system. And gold coins actually first came into existence about 550 BC by the order of King, I can't say his name, so I won't attempt it, Croesus of Lydia, which is now Turkey, apparently. He introduced it as gold coins, and it was used for internationally all over the world, or the known world at that time, for source of payment. When paper money was introduced, it was linked to gold. They still linked the value of paper money to gold. And by the late 19th century, all major currencies were fixed to the price of gold per ounce, which was they called this system at the time, the gold standard. Now, the Bretton Woods Agreement was a monetary system, an exchange rate mechanism that was put into place in 1944, come the end of World War II, where they realized they needed, more, obviously could rebuild a lot and get a system in place. So they actually came up with the Bretton Woods Agreement. Now, this agreement stated that currencies were all pegged to the price of gold, and the US dollar was the main reserve currency connected to gold. Okay, it still remains the global reserve currency, number one reserve currency, the US dollar. So that was, like I say, that's how that started. But then, what happened? Okay, this is why, for example, we go back to my chart here. This is why there is the ultimate love-hate relationship between dollar and gold, is because the Bretton Woods Agreement was ended on the 15th of August, 1971, by the then president, Richard Nixon. And he completely ended the link or the pegging of the dollar value to gold. The US dollar remained the main global reserve currency. But because of this, other currencies, such as, say, the pound sterling, the Deutschmark at the time, the euro was in existence, such as the pound sterling, were allowed to become free floating as well. And due to this action, like I say, this really does show there's a really key relationship, a very key relationship between the yellow metal and the US dollar, obviously nicknamed the greenback. Okay, it's really very much a love-hate relationship. So getting to grips of understanding about gold or gold trading is you need to understand a little bit about their relationship between each other. Now, this is the gold US dollar chart, which I took yesterday, actually, as I was writing the presentation. And this is the dollar yen chart. Now, you can see distinctly that the movement between the dollar, as in dollar going up in value or down in value, can have potentially an impact on the value of gold against the dollar. Okay, so the theory goes, okay, this is not always the certain case because there's other factors at play, which I will show and talk about later. The theory goes is that if you have a strong US dollar, you will have weaker gold prices. Okay, and if you have a weaker US dollar, then gold could potentially benefit. This is one of the theories. Okay, and like I said, you can see they do. This is the dollar against the yen, and this is the gold, obviously, against the US dollar. And you can see that, obviously, when the dollar is going down in value, gold is going up in value, according to this chart. And when, obviously, the US dollar gains in strength, then you can see the negative impact on gold on that. Now, here's a couple of examples of this really at play, and this goes back, if we go back to, say, the 2008 credit crisis. Okay, now to get out of the credit crisis, or to help the credit crisis, the Federal Reserve, okay, or Ben Bernanke, who was the head chair of the Federal Reserve at the time, he decided to introduce what's known as quantitative easing, QA. Okay, and this basically means printing more money. Okay, meaning more money out in the system. He was called Helicopter Ben, actually, because one of the things he said was what he wanted to do. Again, he was joking. He wasn't really going to do this, but get in a helicopter, fly around the country, chucking money out. That's why they nicknamed him Helicopter Ben. So, as you can see, gold was going up quite considerably in 2008 due to the fact that, of course, the dollar was getting weak because they were printing more of it. The more of something, obviously it lessens the value of something. But then you can actually see, and this is when gold was getting up to its all-time high of just around about 1900. But then at the end, or around the sort of the tail end of 2013, the Fed announced tapering. And what does tapering mean, James? Well, tapering basically means ending quantitative easing. Okay, ending quantitative easing. So basically, they stopped printing money. Okay, and that, as you can see, obviously then had a negative impact on gold prices. But you can also see this obviously with the currencies as well. This is obviously the dollar yen. Okay, so when they introduced quantitative easing between 2008 and 2013, okay, you then started to see the dollar at this point. This is around here. This is 2013. This is when they ended it. You can actually see the dollar then started going up in strength against the US Japanese yen. So you can say, like I say, you can see a key relationship. Not always the case, of course, and I'll talk about that later in the webinar, explain why it's not always the case. But like I say, if you have theory is if you do tend to see a weaker USD, then you can see gold benefit. If you see a stronger US dollar, then you can indeed see gold weaken. And currently, obviously, we've got the gold bull run. Now, this is another example actually of a dollar bull run. This happened at the tail end of 2016. And this is when obviously Trump had that surprise election win, which basically gobsmacked all of us. We're all quite amazed by this. And as you can see on the impact of that, the dollar got stronger and gold weakened considerably. But it wasn't just the dollar who weakened, of course, across the board. You also had, obviously, this is the euro. Trump's surprise election made the dollar stronger, and also the euro also weakened as well. So, these are a couple of charts here, like I say, showing an example. We've got the euro dollar there, the pound dollar, and the US dollar, Japanese yen, and obviously gold prices. And at the moment, obviously, we've seen a fair bit of dollar strength, and obviously it's stronger against the euro and the pound and the dollar yen, and obviously it's going up against the dollar yen, and it's stronger against gold. So you can see, like I say, see a bit of that theory. This is not always the case, of course. There isn't always a correlation between gold prices and, say, the other currencies against the dollar. There's not always that correlation. And it's not a dead cert that correlation between the weaker dollar against or stronger dollar against the euro means weaker gold prices. But like I say, the theory is a weaker dollar, obviously better gold, better it is for gold. So with that in mind, okay, when you are sort of considering or watching gold, it's quite a good idea to obviously keep an eye on some key US economic indicators, which can indeed affect gold prices. Now, some of the key ones here are, of course, the trade balance, the US trade balance, which can have an impact. Potentially, if it's better for the US, obviously, you can look at weaker gold. If it's negative, then obviously it has the opposite effect. Non-farm payroll, of course, that's one of the big events, the job number, which comes out obviously first Friday, usually the first Friday of every month. A better figure or a better number than expected, you can see a stronger US dollar and potentially a weaker gold. And obviously the negative job number can have potentially the opposite effect. Then, of course, you have gross domestic product, which is a key economic indicator for the US. Retail sales, I've said this many, many, many times. The modern economy or the modern world is very much reliant on us spending our money out there. The more iPhones we buy, or the more cars and whatever, Xboxes, PlayStations, whatever we buy, the more money goes into the system. So obviously retail sales can have an impact as well. And industrial production, of course, it makes sense. If industrial production is going up, then the economy obviously is growing as well, which could be good for the US dollar, not so good for gold. And the Fed base rate decision. Okay, that can also have an impact because don't forget, when they tend to increase interest rates, potentially that can increase the value of that currency, which of course can also have that effect on gold as well, or that negative effect on gold. And the FOMC statement and press conference, especially when the Fed chair is speaking and things like that, because obviously they drop hints of future policies or future monetary policies they might enact in the coming months or the coming years. Again, this can have an impact on gold prices. And like I say, yeah, press conferences. Now, there's something else about gold. It's not just about the dollar relationship, okay? It's like I say, there's a strong relationship with the US dollar. But like I say, there's other factors you need to bear in mind and think about when you're sort of understanding gold trading. Now, gold is a very well-known key safe haven, okay? What is a safe haven, James? Okay, a safe haven is an asset that people or investors put their money in when things are not going so well, okay? When things are not looking so gloomy, looking gloomy even, or not looking so, rosy. Okay, there is a very famous saying, and it's just a saying, no way whatsoever be taken as any form of advice. It's a famous saying. It's just a saying, and the saying goes that put a percentage of your money into gold and hope it goes down, because if it goes up, things are bad. Okay, and that's just a saying. That's not advice. Okay, so yeah, it's a key safe haven, and what you tend to see when there is times of global recession or conflict, in fact, military conflict or political conflict, gold, along with other safe havens like the Japanese yen and the Swiss franc, can benefit. Now, this is the point I wanted to make. We talked about the US dollar gold relationship and how obviously a stronger dollar can actually mean a weaker gold. This is not always the case, and this is why it's not always a correlation when you see other things, like the euro and the cable and the Swiss franc, for example. This is why there's not always a correlation between gold and their movements against the dollar. And that is because the US dollar is a safe haven as well. So you can see, for example, gold prices go up at times of conflict and concern, but at the same time, you can see the dollar go up against the other currency pairs because it is known as a safe haven, along with the Japanese yen and Swiss franc. Okay, it's actually like the Swiss franc and the Japanese yen. Okay, now, but that is the point. At the end of the day, it is a key safe haven, and that's a very good question. Actually, I've got a good question. Well, hasn't gold acted like a safe haven this time around? And I will come to that. That's a very good question. So bear with me. I'll answer those questions at the end. That's a good question, though, and I will answer that. Now, as well as being a safe haven, gold is also known as a great store of wealth, as though it, like I say, has a key relationship with the US dollar. It's not always, has that effect by economic indicators, because, like I say, it is a store of wealth. The chances of it ever becoming valueless, and bear in mind, don't forget, we're talking about CFD trading. Gold is also a physical, tangible commodity. Okay, which can retain some sort of value and can be used to exchange for goods at some stage. This is why, for example, we'll get onto this slide in a minute, why so many central banks still have massive gold reserves, okay, to protect themselves. So it is also known as a great store of wealth. And like I say, when things are good, things are rosy, things are bullish, gold tends to not be beneficial very well, okay, because people tend to move their money in riskier assets. And this is an example here. For example, look at this, the S&P 500, that's one on our right. Okay, we got gold on our left. If you can see, the stock market is still extremely bullish at the moment. There is obviously thoughts of it finally, maybe, finally ending, but at the moment it's still bullish. So obviously the market has a risk appetite, and they're putting their investment into riskier assets like stocks and S&Ps, and not putting their money into a safe haven. Now, hints of conflict. Okay, like I say, hints of conflict, global conflict, things like this. This is when gold can benefit. And we saw an example of this last year, for example, when, can you remember this? Donald Trump was threatening North Korea. His words were hell and fury, which was pretty silly, really. But like I say, you saw, obviously, the market, you saw the market react in a way that, go back to that slide, market reacted in a way that they started putting their money into gold again, especially Asia did, because again, it was acting as a safe haven because there was hints of that potential, it didn't escalate luckily, but those sort of hints of conflict actually made obviously gold prices move higher. And there is another relationship, of course, and this moves on to the other fundamentals of supply and demand. Okay, and there is a relationship between gold USD and the Aussie dollar USD. Okay, they can, not always, but they can tend to move in unison. And the reason for this is that Australia, okay, is the second biggest miner of gold. Okay, so when you tend to see stronger gold prices, you can see potentially the Aussie dollar also gaining strength at the same time. So this is a key relationship between those two as well. And these are some of the key suppliers of gold. And this is always something worth keeping an eye on, in my opinion. Okay. And these statistics, as reported this February this year, but they're actually based on the US Geological Survey of 2017. So these are the ones who are producing the most, or mining, so not producing, you don't make it, you mine it, of course, mining the most gold. So you have China at the moment with 440 tons, and then Australia second, and then you have Russia, and you have the United States, Canada, Peru, and South Africa. These are all the biggest miners. So this is the supply. And this is interesting, okay, because obviously this sounds a lot, okay, doesn't it? 440 tons of this stuff being produced. But this is something else as well, because remember, we're talking about a physical commodity as well as a CFD. So we're talking about physical. So then we look at the demand, who's, we talked about acting as a store of wealth. So these are the biggest holders of gold in their gold reserves. So you have the United States, who currently have 8,133 tons in their reserve. Then Germany has 3,371 tons. Italy, 2,451 tons. There's France, Russia, China. They're often sort of picking up, getting more of their reserve, and Switzerland. Actually, sorry, go back to that slide because I want to make a point on this. So, like I say, we're talking about a physical commodity. So, if you look at the supply thing was, wasn't huge. It was 440 tons being produced, where obviously we've got, quite a lot of storage. Now, what can affect the price of gold, and what is also worth keeping an eye on and keeping an ear out for and understanding about what's happening, is keeping an eye out if countries start buying more and more gold. Okay, you do get these reports. Things on the bullion desk is a very good source of information about who's buying gold, because they will say, and they will comment to you, that China is increasing their reserves, or Germany is, etc. So obviously, if there's a demand going up for it physically as a reserve, this can have an impact on gold prices, because like I say, supply and demand. The more there is a demand of something, the more it could possibly go up. At the same time, it's a good idea to keep an eye on supply, because if there's a problem with supply, it can also affect prices as well. I give you a prime example of this from my own experience. I remember back in 2008, okay, and this is when I was trading gold, okay, in Dubai. South Africa, okay, had a massive problem with power cuts, which was affecting the mining. At that point, South Africa was one of the biggest miners of gold. They were about third or fourth at the time. So this affected how much they could actually mine, which had an impact on prices. So what I'm saying is to keep it on top of what could possibly affect the prices as well. Understand what demand is for it, and understand what's affecting the supply, and that can have an impact, because like I say, we are talking about a physical commodity as well. Okay, now I will do a full-blown webinar on this. Okay, this is the Commitment of Traders report, which is a free report, comes out every Friday. Okay, it's available to everybody. All right, I will, when I do a full webinar on this, I'll give you the links and explain to you how to read it properly. This is just an introduction to it. Now, what this is, the Commitment of Traders report, known as the COT report, provides the breakdown of positions opened or currently opened from Tuesday onwards in the trading week of several of the major exchanges in the United States. So we're talking the real players here. Okay, now the report, excuse me, sorry about that. The report separates the two groups of traders, okay? The speculators and what they call commercial, okay? Now, speculators are those who are looking to gain profit by going in the right direction, by guessing where the market is going. And they're purely speculating on price movement. So they're looking to make money if they guess the direction right. The commercials, okay, these include merchants. These include producers, so jewelry manufacturers, for example, as we're talking about gold. So they're opening their positions, okay, their future positions, not to gain a profit on speculation, but to hedge their costs. Okay, so they're looking to hedge their costs. So this is how you can read the report. It's the report here. So let's see our two groups first. We have our large speculators. Remember, these group of people are looking to try and profit from guessing the direction right. And we have the commercial. These guys are looking to open positions to hedge their costs. So the theory is, these are the amount of long positions. Okay, so the speculators, if they believed it was going up in value, they will buy more long positions. If they believed it was going down in value, they would buy more short positions. Commercial, if they believed, okay, it was going down in value, they would buy more, going up in value, they'll buy more long positions, protect themselves. If they believed it was going down in value, they would obviously buy more short positions. Remember, they're protecting their costs. So the way to read this report, okay, if the speculators, okay, are buying more short positions, they're guessing the direction's going down. If the commercial are balancing it with both their long and doing short as well, because they're protecting their costs, okay, then it gives you the idea of what the market sentiment is, okay? Market sentiment is. So obviously, if there's more shorts for speculators, they believe the price is going down. If the commercials are doing pretty much the similar or going short to protect themselves, to protect their costs, then the sentiment is, in their opinion, or the way they're looking at it, is bearish. Okay, and like I say, this is a free report available for everybody. You can go in, and like I say, I will do a proper webinar on this Commitment of Traders report to explain it, because it's very useful and you can gauge it to try and gauge how the market's feeling, if its market's feeling bearish or bullish. And it's a quite a good report to engage in. Okay, up and coming events coming up soon. We will be doing on the final one for the month is on the 20th of August. I'll be doing how I learned risk management. And the September schedule will also be released very, very soon. We'll be doing a number of subjects and things. Before I move on to your questions, don't forget, you can speak with me. Email me at james@strattonmarkets.com, or indeed you can follow me on Twitter and message me directly, or follow me anyway, because sometimes I talk a little bit about the market and some news coming up. I try and do it in an entertaining way. Or like I say, if I go back to that bit again, if you have any suggestions for future webinars, which I like to do, okay, please feel free, okay, to contact me, email me and say, James, could you do one on Elliott waves, for example? Or James, could you do one specializing or focusing on crude oil, for example, or whatever. So your ideas, because don't forget, at the end of the day, I'm recording this material to you guys. and ladies, of course, for your to help with your education and your understanding and your learning of this market. So if there's any particular subjects or areas you want me to cover, please feel free to contact me. Now, before I go on to questions, like I say, this is purely being for informative purposes only, just a brief introduction about understanding some of the key factors behind gold. Okay, this is, of course, we're talking about online trading and CFD trading. Like every investment, it carries a great deal of risk. I do suggest you do your own research and due diligence and know of the risks at hand before entering any trade. Now, with that out of the way, let's go on to questions. I've got 2 questions already. One in particular was very good, and I will answer that, actually. I'll answer both of them. First question, I heard that currently it costs $1,200 to extract gold from the ground, so the price won't drop much below that. Is that true? Now, personally, okay, I don't actually know how much the mining costs are. I don't know if it's exactly 1,200, and as you know, it's way under 1,200 at the moment. It's trading at $1,190 an ounce, and obviously some costs for some miners are cheaper than others. Unlike something like oil, okay, where you have like OPEC, who can basically manipulate the price of oil in some ways as they can cut production and keep prices stable. Though we have the World Gold Council, there's nothing going to be very similar to that to restrict it. So there's no simple way of saying exactly how low it'll go. What I will say, though, as I mentioned in the webinar, of course, is gold is seen as, as a store of value. So I think that, there's always going to be some value to it. But, production costs, I can't say. There is no control of that, sort of minings and things like that. So I wouldn't say that's accurate, to be honest. Why hasn't gold acted like a safe haven this time around? Now, this is the question. Actually, was a very good question. I liked it. You're talking, obviously, at the moment, okay, about the current market conditions where we got gold under 1,200, right? Right. Okay. Now, not being funny, we still have an extremely bullish market. Okay, so this is why gold has been under a considerable amount of pressure. At the same time, we still have a very strong US dollar due to tax cuts and obviously recent interest rate hikes. Okay, the impact or potential impact of the trade war has not potentially been felt yet. The market's ignoring it. Okay. And at the same time, the crisis with Turkey, which could potentially also, again, react to political conflict or political issues where gold should then find its element, not being funny, the market at the same time is ignoring it. So this is why gold, for the time being, is not acting as a safe haven. Okay, because at the moment the market is ignoring a lot of these factors and focusing more on the bullish momentum of the markets. Okay, and certainly are reacting a lot more currently to the US dollar strength, which is very strong. I know it's dropped a bit, it's fallen back today, but over the last couple of trading sessions, it's got very strong. So this is why at the moment gold is not acting as a safe haven. There is gold bugs out there. There's gold bulls out there. Again, this is not advice at all. This is something I've read. I read this and kept up to date with this in Bloomberg and Market Watch. They're saying they're getting ready for a recovery in gold as they see the market will start getting jitters. But again, it's not advice. It's just their opinion. They might be right. They might be wrong. I'm not telling you or not showing you what I think. What indicators to look out for to confirm a bullish rebound? Okay, you're talking about technical indicators all around for everything. Okay, well, look, you can always have early warning indicators such as RSI has always been very useful, but that can also be in relation to currencies. I have done webinars on RSIs where I've showed it can work and where it hasn't worked. For those who don't know the RSI, the Relative Strength Index, is something which at the same time tends to sort of indicate if something is overbought or something is oversold. The level of being oversold is 30, so it's between two levels, 70 and 30. If you see it at around 30 or below, it's sort of indicating that the market might have oversold something, which means the market will then start to buy in and give it a bullish comeback. If it's 70, it then tends to indicate whether or not the market is overbought okay, and they might start selling again. So again, that's the RSI. But like I said, I've shown on previous webinars, it's an early warning, and it doesn't take into account breaking market news. So it's not 100%, like everything is not 100%. Again, of course, another bullish rebound, of course, obviously, is you need to understand your trend lines and channel lines, your support and resistance levels. I did one on support and resistance the other day to explain how to spot support and resistance. Again, of course, another bullish rebound, or again, it can act as a bearish rebound as well, or bearish retracement, of course, is the simple moving average crossover technique, where you take a smaller moving average, say 10, and maybe a longer moving average of say 20, and if the small crosses over either up or below the larger one, some traders believe, in the theory believes, that this indicates that there's going to be a change in trend. So those are some of the ones. But I would suggest, if this is something you're interested in, this again, another good question, I might do a special webinar purely on these sort of indicators for you. So please email me. It's easy for me to say. Email me and let me know if you want me to focus maybe more on technicals. Is there any other questions at all? Any other questions you would like to ask me? Anyone? Ask me anything, apart from my private life. Well, you can ask me that. I might tell you, I might not. Any other questions? Okay. If there's no question, did everybody find it slightly useful, or do you find it informative, at least? Was it informative? Did you enjoy it? Or are you sick of my voice by now? No? Thanks, James. It's very important. Excellent. Brilliant. I'm glad you enjoyed it. I'm glad you found it informative. And I hope is it Roxana? Is that how you pronounce it? Am I pronouncing it correctly? Is that how I say your name, sir? Yes. Is that your name correct? Well, anyway, listen, I hope it is. I'm terrible at pronunciation, so forgive me. It is. Brilliant. I'm glad I'm saying it right. Well, listen, thank you very much for attending. And by the way, great questions, by the way, especially the question you asked about why hasn't gold acted like a safe haven this time round, because that's a very good question. So thank you for that. And I'm glad you found it informative as well. So that's a cracking question. And like I say, please feel free to email me directly if you have any topics or anything you'd like me to work on in the future. On that note, if there's any questions, again, thank you everyone, every one of you for joining me tonight. I hope you found it at least quite useful and informative. Till next time, can I wish every single one of you depending, of course, where you are around the world, a very good morning, a very good evening, a very good afternoon, or a very good night. And till next time, all of you, trade safe.